The world loves a good reboot, right? Well, it's time for me to go into the reboot vault and bring back an old classic with some new bells and whistles. Welcome to another week of Talk to Me Tuesday. Now, I just want you to know, you probably didn't know this, but September is Life Insurance Awareness Month, or LIAM, hashtag LIAM. You might see that on the internet in some places, especially if you follow people who do what I do as far as producing insurance policies and things of that nature are concerned. So it's a whole month dedicated and ignored because people really just don't understand or know that they don't understand what life insurance is. I mean everybody, you have a just knowledge about it, right? So it's what? It's insurance, something that you have when you pass away. Your family may or may not get some money depending on if you took care of said policy or not. But the thing also is, when people are in the market for these policies, of course, odd things happen. Yes, odd things happen. You deal with a producer who maybe has one type of insurance, and they may, talk bad about other kinds of insurance, primarily because that's not their product. If you're looking for a cheeseburger and I sell chicken sandwiches, I don't want you to go over to the cheeseburgers. I'm gonna talk bad about the cheeseburgers and hopefully, convert you over to the chicken sandwich. But you didn't want that damn chicken sandwich. You wanted a cheeseburger. So, now you're unhappy because I wouldn't take no for an answer. Things of that nature. It gets really weird. It gets really funky, especially if the said producer is hungry for a deal, starving, or whatever. But I want to break down the types of life insurance that you can get from anybody that has a license. You have to make sure that you, as the consumer, are asking, what kind of policies do you have? If you don't know anything, if you don't know nothing after this video, then either you weren't listening or I did a poor job, right? So let's just get off into it, right? So, one type of policy that you can get is a term policy, right? So, as the name will tell you, it has a term. So, there's a beginning and there is an end time. So, it could be, depending on your age, it could last all the way to 30, 35 years or so, or whatever. Then after that, you're not insured. They may have an option where you could potentially convert that term policy into a whole life policy, but at that point it's going to be converted to a whole life policy at your current age and not the age when you first got the term. So basically, when that time limit is over, you are going to be back in the market for another policy if you don't have a whole life policy already. Now, there are people who use term policies for a thing that's called mortgage protection, which basically means if something funky were to happen to you at any point in life, at least you would have that term policy to pay off the house, right? That's what I mean by mortgage protection. So you at least won't have to, move out of your house should something wild life happens to you. You wouldn't have to necessarily do that. because you would have the means to make sure that the mortgage is paid and all your other bills, right? So then we branch off into whole life policies, right? So this is the beginning of your permanent policies. And what I mean by permanent is you carry them until you can't carry them anymore, which means you're either going to, one, age out at 100, or you're going to pass away, right? These policies come with these things that are called accelerated benefit riders. Let me go back, because some term policies are now evolving to the point to where they also offer accelerated benefit riders, but of course that would make them a little bit higher than the term policies that don't. Okay, so back to the whole life policies, they come with these accelerated benefit riders. Now, what you're going to notice is they're going to say something about your premiums being not flexible. And what they mean by this is, like with other permanent policies that I'm about to cover, you have a range of what you could pay in order to keep the policy intact. But with whole life policies, you don't have that, because they're offering you a guaranteed interest rate on your cash value. Now, a portion of your premium is going to go towards the cash value, which is basically like a savings for your life insurance policy. The other half is going to go into the policy, which basically keeps it intact, right? So they can't offer you any wiggle room there, because they're offering you a guarantee on the interest rate of said cash value. Now we branch off from there and we go to universal life, right? So now we're starting to get to the permanent policies that have those flexible premiums. And why, like I said, there's a range in which will keep the policy intact should you either decide, I think I want to pay a little bit less, or you be like, this is okay, I think I'll stay right here. And the reason why you would do that, of course, would be like maybe affordability, and it will have direct dealings with the cash value policy, with the cash value on said policy. Like, it just won't grow as fast as you would if you went from paying 64 to maybe 56 or something like that. Your cash value wouldn't grow as quickly as it would should you have paid basically the maximum of said limit, right? They have the accelerated benefit riders that I just discussed. Like I said, and it's also a permanent type of deal. Like I told you, whole life, you have it until you die, or at least until you turn 100. With universal life, you have it until you turn 120. So should you make it to 120, you'll still have that policy. You turn 121, or if you were to turn 101, then of course they would cash it out. If you have it set up right, they'll give you your cash value and the face value, despite what people say. If they don't offer that kind of deal, then they'll only give you the face value of the policy to tell you to have, live the remainder of your life in abundance. And then from there, we branch off to index universal life insurance, right? So this is the thing that a lot of life insurance companies are gearing towards, primarily because they're getting away from their guaranteed cash value deal. They would like for you to believe that indexing your cash value would potentially offer you more growth than what a guaranteed offer could be. And at times it could be right. And why I say at times, because of course your interest rate basically mocks the S&P 500 or whatever else that it has as far as how your interest is calculated. For example, let's just say with a whole life policy, they offer you like a 3% guaranteed interest rate, right? With an IUL, you could have what, 9.75, which I've had. You could have a little bit less. It'd be somewhere usually around maybe 5 to 7 or something like that annually. I mean, 5 to 7 is greater than 3. So they want to move closer to that because of the greater chance to have a greater impact on your cash value, on top of also providing you with those flexible premiums that I just told you about. So that's why more companies are moving towards those IULs. They may be getting rid of those guaranteed types of deals because in their mind, they're doing what's best for the consumer, right? And then you also have other policies out there, you know, it's called accidental death and dismemberment. There are people who assume that they have life insurance because they have accidental death and dismemberment, but the name accidental death and dismemberment means you have to have an accidental death or dismemberment in order to utilize it. So if you die of natural causes, you cannot use accidental death and dismemberment. Right? Okay. So from there, we also branch off into variable life insurance products. Now, variable, these are stock based as far as the cash value is concerned. So, of course, a broker would be able to assist you with that. If you just have a regular old life insurance license, you can't produce that kind of deal. All these things together can be combined. You can have term policies, you can have whole life policies, you can have UL, IUL, you can have accidental death and dismemberment. That also comes as a rider, but it's also a standalone policy as well. Like, you can mix all of these things together if you have the money to do so. If you get approved for all of them, I mean, sky's the limit, right? I mean, the rappers always say how much money is too much money, but it never really translates to us in life insurance because somebody will say, man, $10,000 is enough. Whatever.